Welcome to the BOGART Effect, a wealthy wisdom podcast. The following BOGART Effect podcast is intended for general information purposes only. The information discussed is no substitute for personalized investment advice from BOGART or another investment professional. Please see important disclosure information at the end of the presentation.
All right, good morning. Welcome to the BOGART Effect. I've got Daniel Evans with me today, and we're going to talk about the housing market. Thanks for the time, Daniel. What I want to do is kind of spend a little bit of time at the forefront talking about where we're at, what's gotten us to where we are with the housing market. Then I want to spend a little bit of time talking about interest rates. Obviously, that's had an impact on where we currently are. And then we'll get into talking about a little bit of a future outlook and predictions of what we're anticipating. So why don't you kick us off, Daniel?
Yeah, excellent. Thank you, James. When you hit the nail on the head there. When we look at it, today's housing market, it's very important, imperative to understand, what the events that have taken place to where we've ended up today. And then, like as you said, we'll touch on it as, okay, this is where we're at today. What do we see coming down the future? It's kind of hard to, believe it, but we're still talking about the pandemic and the impact of the pandemic and which it's had, all around us, but today specifically the housing market. We saw a shift within the employment workforce. We saw a shift within population and movement and migration to other parts of the country. And then the big one, we had interest rate cuts, and the drive and the speed at which we drove those interest rates down has greatly impacted the housing market and the environment that we see today.
Well, and truthfully, I'd also even say the buyer pool has changed. And historically, home ownership was only for the affluent, right? And the younger generations, just from a generalization perspective, they were more mobile, more transient. They were typically renters, and you're absolutely right. The pandemic changed a lot of those themes. So now, for example, the millennial buyer became a very, very active buyer in the housing market, and almost overnight created a massive, massive shortage in housing. And that's nationwide, right? That's not even just in certain segments of the economy. And then, as you pointed out, I think the work from home narrative is still very much alive and well. It very quickly changed a lot of the trends in terms of where people wanted to live, because you were no longer forced to live in cities or even in the suburbs of cities. You could now live more where you wanted to live, and maybe occasionally commute to work, but not have to be necessarily where the office buildings are. And so when we talk about the now, I think it's really important to emphasize the fact that these trends don't change immediately, and they don't change overnight. And there's a lot of, let's just say, stickiness associated with how to get there. And really what I mean by that is when someone starts to get into the mindset of, I want to buy a house, it isn't always, all right, that weekend you go and you buy a house, right? Like it can take months of planning, and ultimately that momentum continues to build, where then you start to get emotionally invested in it. Then all of a sudden it's like, well, I might have spent $500. Now I'm willing to spend $600 or $700. And so that also creates some price pressure that's also happening as well. The low interest rate environment certainly brought down the cost associated with it, which made it a lot more attractive, but it did not change the generalized trend or momentum there. So, when we talk about millennials and specifically their impact, I mean, we're talking approximately 85 million Americans now that are looking to buy homes. Now, of course, some of them have already bought, but that trend has absolutely been what has been the most dynamic shift in the current housing market. Not saying that Gen Xers, baby boomers weren't a big part of that. They still absolutely are. But if you go from all of a sudden having again, we're talking more of a generalized a reference point. But if you go from having a generation that's not an active participant in the housing market to then all of a sudden very active, well, of course, you're going to have a massive housing shortage. I think the other thing that's important to talk about with regards to trends is inflationary pressures. You can't ignore it. Cost of building has doubled to tripled in the last 4 years. And depending upon that, there is some regionalization associated with that. But that's more than just land values. The actual cost of construction has risen so fast, so materially, that you can't ignore inflation here. And so that, of course, has had an impact on people's ability to afford homes and ability to afford what they want. And so, of course, that's caused a migration or shift, some of that work from home narrative that we're having are kind of entangled with that discussion, where people can now live where they want to live. They can move to lower cost of living areas and ultimately then have a home and be able to set roots there. And then the other thing that I think is important to note is the inflation that's happened on wages. You know, we've literally seen over the last 4 years the fastest real wage growth, so relative to inflation, that we've seen in over 40 years. And because of that, that means that ultimately there is more discretionary income. Now, I might argue that point a little bit simply because when we talk about discretionary income, real costs across the board have absolutely risen. I'm sure, Daniel, you've had food costs are higher, childcare costs are higher, right? We're in the same boat in that regards, right? Like, real costs have risen. But at the same time, too, because people have higher income levels, ultimately that means that they have the ability to qualify for bigger mortgages, which means that they have the ability to buy more or buy a higher priced home, right? The way I see it is there's three different segments in the housing markets right now. There's the housing market that's under 500,000. There's the 500 to 1.5 million, and then there's the 1.5 million and above. And all three have had a different segmentation that's happened. And the reason that I bring it up this way is simply because ultimately there's a direct correlation with how much someone is financing versus their the inventory at each of those respective levels. Right. So for example, typically a home price that's under 500, more often than not, that's usually the starter homes. And that's usually where somebody is going to need to have a very, very large mortgage. And they're usually putting 10, 20% down, financing the rest, which means that they're being impacted much, much more by interest rates right now. Whereas the 500 to 1.5, that's typically where you see more of the larger cash transactions. So there's a lot less sensitivity to interest rates. And then the 1.5 and above, well, that's typically where we're getting into a discretionary level where interest rate volatility is relative, right? I'm not trying to minimize money, but relatively unimpactful relative to the purchase price itself. What I will say is inventory is very hard to come by, and this is across the country. Certain regions are better than others. But what we're finding, though, is if priced appropriately when something comes on the market, more often than not, they're getting offers very, very quickly. And in a lot of instances, we're still seeing bidding wars. We had one of our team members down there in Houston when she was getting ready to buy her first home. I think it was 27 homes that she put offers on before she ultimately got one. I mean, that's crazy to me. But the environment that we've been talking about here. And by the way, I don't think that trend is going to change in the near term. I think that we're still going to see the ramp up period taking a while to get the inventory back to a place where we're going to see enough supply to equalize out the demand, right? So let's shift gears a little bit and talk about what interest rates have done, Daniel. And let's specifically talk a little bit about how those have gotten us to where we are now. And then let's start transitioning into talking about future outlooks.
Yeah, absolutely. When you look from an interest rate environment, right? I mean, from the cause of the pandemic, I mean, the rate of acceleration to cut rates was historic. I mean, we've had historical lows. I mean, we look at what interest rates used to be in the 80s and 90s, and all of a sudden we've got sub 3% mortgage rates here. I mean, that we're at historic lows here. In context, I mean, even if we settle around a 5 or 6% interest rate, I mean, historically, it's still a relatively low number, but it's a shock to the current environment that we have with it. So the cause of that to stimulate the economy through the pandemic and have that, I mean, it's really driven the cost of capital has really come down, so there's more availability to it. Well, now that interest rates have gone up, and they went up at a very, very fast, or we're moving up. It won't go up as high as it went down, but we're moving into this environment where now it's proverbially called your locked in phase, right? So now I've got a mortgage that I'm at 3% on it. I mean, I've got to sell, absorb a higher rate going into the future, but also with the price increases in homes, your dollar doesn't go as far when you look at it, right? So, supply and demand, affordability, and this lock-in period I see is really, driving the dynamic in there. And I think that when we get into a lower rate environment, that we could see a little more momentum on the buyer side and the seller side as sellers can become more incentivized. will be more available to buy homes going forward.
Well, and I want to pull on part of the thread regarding interest rates. I think it's important to really talk about relative timing. Most baby boomers, their first home mortgages were 11, 12, 13, 14, 15%. So it's important to note that, it doesn't feel great locking in a 6.5% or 7.5% mortgage right now. But relative, again, it's all a function of timing. Now, somebody rebutted me recently and said, well, home prices went up 10x, right, in the same time frame. Well, I won't argue that, but real wages have as well, right? So this is where when we talk about the now and try to compare it to any other timeline, I personally don't buy into that. I think it's important to work within the environment that we have presently, and then think about where it is ultimately in the future. And by the way, I personally don't think that current interest rate environment should detract or preclude someone from buying a home if they're choosing to buy a home. And the reason I say it that way is simply because right now, the environment is what the environment is. There's a lot of sellers who are saying, I'm going to wait to sell my home until interest rates come down, right? And what's going to happen then? Well, now all of a sudden you're going to get potentially a lot more buyers as well coming in, which is going to continue to drive the prices up. We're in an environment right now with higher interest rates where, because things are still potentially sitting on the market, you have a little bit of negotiating flexibility, right? That this is the time that if you're trying to buy, go ahead and buy right now. And then be very diligent with regards to refinancing. And so when we talk about mortgage products and what someone should or shouldn't do, I think it is important to talk about what a mortgage is, how it impacts someone's ability to afford. By the way, the calculus for qualifying for a mortgage is a very simple formula based upon what someone makes. There's a front end ratio, back end ratio, 32% of income, 38% of income. That's what would ultimately qualify someone for a mortgage. That's what the lenders are using as the goalposts, if you will, to determine a qualification for a mortgage. But then there's all different types of mortgage products. There's a 30-year, there's a 15-year, there's a 5/1 arm, there's a 5/6 arm, there's a 7/6 arm. The reality of it is that this is a great period of time to talk to a financial advisor for what is appropriate for your situation. A lot of this conversation is where we're engaging with the kids of our clients, right? And happy to be a resource there. But I do believe, right now, there's not a whole lot of incentive to go with a variable rate product based on the differentials in the rate. So, personally, I would look at doing a 15 or a 30-year, depending upon what my cash flows would provide for me to be able to afford. There was a whole trend where, and this is going back maybe 10 years now, where interest-only mortgages were extremely attractive. I think that's very dangerous for somebody who doesn't have a tremendous amount of either assets or income to offset those, because what happens with those interest onlys is those mortgages reset at whatever the duration is. Some of them are 5 years, some of them are 10 years, whatever the duration is. And that's where people get in trouble. And by the way, that's essentially what built 2008, 2009, great financial crisis, right? It's these resets all happening. So my point with all of this is, if you're going to get a mortgage, make sure you understand what you're doing in terms of what the implications are. If there's going to be a time where that mortgage is going to shift or reset because of a higher or lower interest rate environment, right? Just understand it. But then at the same time, too, understand what is that doing in terms of your discretionary cash flow? Do you have the ability to continue to live the life that you want, or are you going to become house poor, right? So just build all of that into these assumptions here. Now, I do, to my root core, believe interest rates are coming down. If anything, if I was a betting man, I'd be wrong even for 2024. I would have thought rates already would have materially come down.
We went from a 7-cut prediction, so I agree with that. I don't know exactly the schedule and what it's going to look like going forward, but yes, I mean the momentum and the direction is that we will find ourselves in.
Well, and truthfully, like I go back to 2019. That year, I refinanced twice that year because rates kept coming down. And it becomes a basic math formula. For anybody who doesn't know, refinancing means that you essentially go get a new mortgage for a house that you already own. And it enables you to bring the interest rates down, bring your payment down, right? Or you could potentially look at changing the type of mortgage that you have. I ended up actually, I remember in 2019, I went from a 30-year to a 15-year. And my payment only went up by a couple $100, right? Because of the way that interest rates came down. And of course, accelerated repayment. And it's fascinating because we talk about the aristocracy of rates right now. The challenge that a lot of homeowners that are talking about selling is anybody who bought a home between 2020 and 2022 or early 2022 that has the sub 3.5% mortgages. A lot of them don't want to sell simply because they're never going to be able to see that mortgage rate again.
Right.
And that's a struggle, right? Like in the hardest part, I actually sold a home that I bought in 2022, locked in the rates. And I had a 2.875% mortgage. Hardest part about selling that house was giving up that mortgage rate, right? Like, ultimately decided to downsize the house itself and was able to reduce cost structure. But, that was hard, right? Like not having you're giving up that lower mortgage rate.
Right.
All right. So let's talk a little bit about, where we see things going in the future. We've kind of touched on it a little bit as we've gone through the talk so far. I think, as I said, there's a conversation for 2 to maybe 3 cuts in 2024, which, by the way, is what the Fed came into the year anticipating or guiding. Market came in with 6 to 7 and has since revised its expectations back. But going into 2025, we're anticipating 5 rate cuts. So, that's what the Fed is indicating at this point. So the reality of it is that rates are going to come down. We just can't tell you when. So with regards to mortgages, now, by the way, the Fed's fund rate does not have a direct correlation on mortgage rates, but it does impact trajectory. Right. So I think it's important to just be diligent, be ready. I could see a scenario where people are going to refinance multiple times by the time, this rate cycle is fully done, going into 2026 and 2027. But the reality of it is I would not let the current interest rate environment preclude someone from buying a home today if that's ultimately what their plan is. Now, if you're on the fence, if you have uncertainty, yeah, absolutely don't buy. That's kind of generalized guidance. The other thing while I'm on it is I will say if you're going to be in a destination or location less than 3 years, I typically would steer you away from buying in the base case, right? And the reason I say that is simply because of transaction costs alone. And then, of course, market risk associated with whatever happens in the housing market. If you know you're only going to be there for a very finite short period of time, I would encourage to rent, don't buy. Because you're 6% just in realtor fees alone, plus whatever market rate does, and then whatever it is to buy the house, get in the house, and then move. I would tell you just rent if that's the case, if you're going to be more in a shorter period of time. Right. Now, future outlook. I want to talk a little bit about those segmentations because I think it's important to talk relative. So under 500,000, 500 to 1.5, and then 1.5 and above. Yep. I do think that when we talk about the under 500, there's just absolutely not enough inventory of them. Right. And a lot of that is because what used to be under that price point has moved to the 500 to 1.5 thresholds, right? So we've seen price escalation happen. So there really isn't enough inventory at that lower price point. And I think that the reality of it is cost of construction still precludes new entrants into that market. So now we're seeing, more of the high density housing at those price points, townhouses, for example. Condos, et cetera, right? Like usually are in those price points. But then the 500 to 1.5, we're starting to see some inventory building up there, but really not a lot materially. And then honestly, the 1.5 and above, in my opinion, that is a separate market class that the good will continue to transact quickly. The stuff that's overpriced is going to sit, which is ultimately going to preclude someone from getting a transaction. Anything you want to add there, Daniel?
No, I mean, when you look at it from, going forward across those segments, I mean, if you were a homeowner before, this environment, I mean, now you've got a lot of equity, with your price and your home increasing there. So there is an availability, or there are funds to move towards it or buy another property. Going forward, I believe that, barring some kind of recessionary, environment, that these rates are where they're going to be, and they are more impactful in our, sub 500 segments there. I mean, the median price national average has skyrocketed. Interest rates have skyrocketed. So that question of affordability in that segment is always going to be there right now. I mean, you said it. The answer is there's just not enough supply from it. There's not, and even with the new builds, I mean, they're still even struggling to meet with it as well. So I don't see that. Kind of our mid segment, it's basically, there's going to be a balance, there, and I think that balance is dictated by interest rates, there, and creating an environment that's more favorable to selling your house and realizing, some of the equity and the price fluctuation there.
Well, and then I think regarding some of the work from home trends, right? Like we have to continue to watch that. I do think that we're starting to see more of let's just say a hybrid. Where businesses are either doing a 60% or an 80% in office, which then means that if you had moved to an area that was 2, 3, 4 hours away from where your primary office was, that's a lot harder.
Yeah.
And so then, that of course is starting to create some of that pressure back. Now, I will admit that I have a hard time believing businesses are going to just outright fire people for not coming back to work. Right. But again, I think it depends more on a macroeconomic environment and really the strength from the employer and the workforce. And one of the things that I've been told recently that I've been putting a lot of thought into, but is this workforce, and this is now talking about millennials and Gen Zs, is that you need to meet them where they are. And what is it that they want? And this is where, as an employer, I still struggle a little bit with that conversation because, yes, we want to be as accommodating as we possibly can, but there is a lot of efficiency with being in office and a lot of efficiency in having the workforce together, et cetera, et cetera, et cetera.
Yeah.
So my perspective may be a little jaded in what the work from home thesis is, but the reality of it is that is still going to be a very big driver with regards to the future of the housing market. And I don't see that changing, by the way. And so watching that closely will ultimately have a direct implication, especially if you're in the market to buy a house and you're trying to kind of navigate where you want to be. And by the way, certain economies have been more impacted than others. And like I have direct exposure to Virginia and Texas. And Texas, the work from home narrative never really gained a ton of momentum, whereas Virginia, it absolutely did. And so you saw a relatively large, let's just say, divide in terms of mindset associated to work from home. And so then when you have businesses who have multiple locations, multiple areas that are being impacted, the housing markets are just different, right? Yeah. Now, by the way, Northern Virginia, it's just kind of an animal of its own, simply because we have so many government jobs here. There's just not enough inventory, period, the end. And you've seen this sprawl that's happened. And I would add, anecdotally, doesn't have very good mass transportation system to be able to facilitate, the inbound. Similar, even with Texas, the Houston market, for example, just has no mass transportation, really. I mean, some buses, right? But, and so, of course, it's placed more emphasis on road systems. All in all, I'll say this. I think that housing is still going to be very much driven by lack of inventory. The interest rate environment, to me, is going to have an impact, but it's anecdotal at best. If you need to buy, go ahead and buy. But I think ultimately it's one where be mindful of the decisions that you're having, integrate it with a financial plan, and making sure that you're talking to your financial advisor along the way.
Yeah, spot on. At the end of the day, it's how does this work within your own affordability, your own financial plan, which is an imperative component. And as we kind of navigate this market and the decision of, buying and selling a home.
Yep. Daniel, thanks for the time today. Appreciate it.
Absolutely. Thanks, James.
Take care.
The previous presentation by Bogart Wealth was intended for general information purposes only. No portion of the presentation serves as the receipt of or as a substitute for personalized investment advice from Bogart Wealth or any other investment professional of your choosing. Different types of investments involve varying degrees of risk, and it should not be assumed that future performance of any specific investment or investment strategy or any other non-investment related or planning services, discussion, or content will be profitable, be suitable for your portfolio or individual situation, or prove successful. Neither Bogart Wealth's investment advisor registration status nor any amount of prior experience or success should be construed that a certain level of results or satisfaction will be achieved if Bogart Wealth is engaged or continues to be engaged to provide investment advisory services. Bogart Wealth is neither a law firm nor accounting firm, and no portion of its services shall be construed as legal or accounting advice. No portion of the podcast content should be construed by a client or prospective client as a guarantee that he or she will experience a certain level of results if Bogart Wealth is engaged or continues to be engaged to provide investment advisory services. Copies of Bogart Wealth's current written disclosure brochure and Form CRS discussing our advisory services and fees are available upon request or at www.bogartwealth.com.